where we take time to go over wealth management concepts and helping clients and guests to create, grow, protect, and preserve wealth for their family in today's economy and looking forward into the future. As we start tonight, I remind you once again of the important disclosures. For those of you who have attended many of these workshops in the past or these advisory reviews in the past, you're familiar with this information. For those of you who are guests tonight, this is information that we encourage viewers to think about when they're making investment choices. When we are taking a look at investment strategies through these wealth advisory reviews, we show various investment issues, things that may impact taxes, things that may impact planning, or items that could impact their trust or estate design work. And so we encourage people to get all the information to make an informed decision. And when it comes to tax issues, we are not accountants, but we have a lot of information and data that can help with things. But in the end, any decision that would impact your taxes should be reviewed with your accountant. Same thing's true with estate design. We're not attorneys, but anything we would show you, you should ultimately review with your attorney to make sure that it makes sense for you and your family. We have a lot of valuable information to share for these various items, but we want our clients to make the last decision, the final decision, because it's their life and their future they're working on. We will have time later this evening at the end of the event to answer questions. You can either raise your hand, or you could type your question in the online chat, and we'd be happy to go through that with you. It'll be more towards the end of the review when I go over all the information. But if you hear anything that you want to discuss, just make a note to yourself, and then we can talk about that at the end of my review tonight. Tonight, we're going to be discussing some items that I think are they dovetail nicely with what I covered last month, and they fit well with where we're headed as we move into next month and the rest of the year. We're going to do our usual market and economic review. We're going to talk about how chasing performance can make you miss opportunities. Uh-oh, something happened here. Well, that's surprising. Give me a second here. I'm going to have to stop sharing the screen. For some reason, the PowerPoint presentation disappeared. Just give me 1 second. I'll be right back with you. I'm still here. We are uploading the PowerPoint presentation. For some reason, it turned off. Maybe get yourself a cool drink, and I'll be back in just a quick moment here. Give me 1 second, please. I have no idea what happened there, but for some reason, Microsoft PowerPoint just turned off completely and then did a restart. I guess, uh, I don't know. We will continue on here. Let me resume the presentation, the advisory review for you. All right, so as we do always, we will take a moment, look at the market and economic review, and then discuss how chasing performance can make you miss opportunities. We're also going to talk about seven cognitive investing biases that affect your investments. We're going to talk about how to counter investors' cognitive biases, as well as our wealth management process and how we use that to help with that process. I'll share with you some final thoughts that I have after going through all the material with you, answer your questions, and then share with you the next advisory review and what's coming up with that. So let's take a moment now and just look at the equities market and where we are right now. I'm going to switch over to the actual market data. All right. So looking here at the S&P 500 large cap index, and again, for those who are guests, the S&P 500 represents the 500 largest companies in the U.S., divided up by the 11 industries. What we can see here in this chart is that the markets have continued since November to climb. We've seen a lot of strength, both in performance as well as we look at the 50-day and 200-day moving averages. The market continues to move forward. I know that for some that's confounding. They are not quite sure why the markets would be doing so well based on concerns they have about future market and economic issues. We're going to cover that a little bit tonight as well. But what I would say is that we've seen a very nice steady movement up in the S&P 500. I would also point out that the relative strength indicator since that period of time has continued to be pretty high. It's currently at 58.1. Anything above 50 is considered positive territory, but you'll note that it has moved down a bit. However, it moved down a couple of different times, then resumed its position well above 70. So we're watching carefully to see what's happening with that. As you can tell by the volume, the information going on as far as the number of shares that are being purchased on a daily activity in the markets, much more green than red. We did have a couple of days where we had some above average volume on the trading. We can also look at the short term moving average convergence divergence, or what's called MACD, and we can see that it's well above its center point when we look at the 12, 26, and 9-day moving averages. We can see that it is continuing to move higher or maintain that good position. So again, everything can change in a day or a week or even a month. And we're watching on this, and that's one of the reasons we have these reviews with you to share with you what we see happening. At this point in time, despite any concerns about the economy or politics or other items, I would say that it looks like the markets are strong and the economy has this robust feel to it. Probably a lot to do with interest rates coming down, probably a lot to do with unemployment being low, probably a lot to do with a lot of capital or cash in the markets or not markets, but in people's hands that they want to do something with. We are in an election year, and historically, election years have been pretty decent years for the market, and so that may have some impact as well. So as we look at this each month, we will be updating you as to what we see happening, what concerns we have on the economy or the markets, and what opportunities we think are there. When it comes to sharing more detail on opportunities, I tend not to do that in the advisory review because I'm talking to a number of people here, and what I might recommend could be valuable for one individual, but not for another person, based upon their risk tolerance or their income needs or their growth thinking and their planning as far as whether they are close to retirement or quite a ways from retirement. And so we're not going to go into individual issues, but if we look at the markets overall, the S&P 500, the Dow, and the NASDAQ, it's been a pretty nice ride for the last close to 6 months. And we're watching carefully, but I think that may continue at least until we get to the summertime where it might flatten out. Again, going to depend a great deal on other information that comes along, both domestically and internationally. But at this point, even though we have some conflicts going on both in the Middle East and over in Russia and Ukraine, the markets do seem to be holding well. Fuel prices are still low. Inflation in some ways has come down, but in other areas like food and daily goods and so on, not so much. But all of these together still seem to be creating a pretty universally satisfied sense about the markets and the economy at this point. We will continue to watch this closely for you. And if you have any questions, certainly we can talk about that here at the end of the presentation or in your next investment review when we're going over your accounts with you. And you don't have to wait till we call you. We'd be more than happy to take some time to visit with you before that time comes if you have any questions or thoughts about that. Now, as I stressed in the last month's advisory review, nobody seems to consistently forecast future market performance. This is looking at from 2023 all the way back to 2018, looking at a consensus of the S&P 500 estimates by fund managers and pension managers, insurance company executives, looking at an estimate of what they thought the S&P 500 would do, and then comparing that to actual returns. And as I shared with you last time, the consensus was 7.5%. The actual was 6.2%. So it was a difference there of about 14% over estimate on what was going to happen. And then we come to 2019. Expectation was going to be somewhere around 13.7. It actually turned out to be about 28.9, 15% underestimate of what the markets could do. 2020, which was obviously a crazy year because of COVID, expectations though were going to be about 2.7, actually ended up with a positive return of 16.3 in the S&P 500 that year, an underestimate of 14%. In 2021, we had an expectation about 1.2%, and the markets actually did 26.9%, and that's an underestimate of 26%. 21% an overestimate in 2022, where the markets were expected to do about that same 1.2%, but they actually went down 19.4%. And last year, expectation was about a 6.8% growth. The markets actually came through at 24.2%. The reality is that as each of us work on our portfolio management, whether it is advisors helping clients to figure out what to do, or investors trying to make wise decisions in their portfolio management and wealth management needs, we need to take time to recognize, as I said a little bit about last month's advisory review, and I'm going to hit it a little harder this time, is that confirmation bias has a lot of impact on what's happening in our investments. When, for instance, I could see in 2023 that the markets were doing better than we thought, the economy was doing better. At the same time, I had many clients who were more concerned about it, and so they wanted to hold off. And then later in the year, once a lot of the growth had happened, they now thought that made sense, but by then we'd missed some opportunities. And so trying to work through this process and dealing with biases in our thinking is a big part of what, as an advisor, a fiduciary, or an advisor working on a fiduciary model, we're working hard to try to help people think through what to do and make the best decisions they can. So I would point out again, just as I said last time, it's especially important to remember, because investors, like humans, all humans, are subject to confirmation bias. Thus, when we hear a forecast that confirms our own beliefs or concerns, we're more likely to act on that if we hear a contrary opinion. To act on the positive, the one that agrees with us, or the negative, the one that agrees with us, rather than the one that's contrary. And so, as an advisor, what I'm going to tell you is that we try to help people think through the process of how to invest accordingly. And what I find is that if the client has a concern or a negative thought about what's happening in the economy or the markets, it tends to make me be more careful for them. Not because I may think it, but rather because if their concerns come to fruition, they're going to then be disappointed that I didn't listen to what they're saying. Now, as somebody who's trying to act in a model that is fiduciary in thinking, meaning that we're trying to put ourselves in our client's place and try to invest accordingly to make the best of the situation for them to meet their goals and protect their investments and provide income and growth that they need. When we're trying to operate in that model and they're expressing concerns, or maybe the reverse, they're expressing optimism, then we're working to try and help put that in place for them. So if a client is particularly dour about the economy and the markets, even if I'm not, I will share that, but in the end, we're going to operate like they want to operate. So that also feeds into this. So that's why I wanted to spend some time tonight to make sure that as we're looking at our clients' investment strategies and their thoughts or biases about how things are working, to help maybe make it so we can, you and I together, can make the best decisions long term for you and your family while considering the short term needs that we're all forced to deal with. So chasing performance misses opportunities. I did share a piece of this last month as well, but I wanted to just address it one more time before we get too far into the process. Chasing performance, or maybe staying away from certain investment types because we're concerned about market issues, typically can cause investors to miss opportunities. From an article, Individual Investors Are Performance Chasers. This comes from Morningstar. Historical evidence demonstrates that individual investors, as performance chasers, they buy yesterday's winners, they buy the things that did well last year or the things they've read about after the great performance, and then they sell yesterday's losers after the loss has already been incurred. And that at first glance seems maybe not very wise, and yet at the same time, I can tell you, we see people doing it all the time. They want to know what were the best performers last year and why aren't we in those? Well, those things may not have been the best things to be in now. And so we take a look at what opportunities are out there to try to identify the next best strategies for making wealth grow, while at the same time considering that individual investors have concerns or thoughts or biases about what's going on in the economy and the markets. Simply put, investors typically are more likely to buy when the investments or the index or the mutual fund or the stocks are at highs because they've heard about them and like, well, we should buy in now. But typically, if we've missed a good chunk of that upward momentum, we are now going to miss that opportunity. And then if it turns and falls, because that is usually the cyclical nature of investments, that investments that can go up nicely can also come down, and then they recycle again, as I have shared many times before. They end up buying high and selling low, which is not a very good strategy. Understanding and countering investors' biases can help us have a longer term approach and create more satisfied investors, which is what this is about in tonight's conversation. 7 cognitive biases that are impacting investors. Something called confirmation bias, overconfidence bias, loss aversion, recency bias, endowment effect, optimism/pessimism bias, and political bias. So let's take a moment and kind of look at each of these. Confirmation bias, the tendency to seek out and interpret information that confirms or strengthens our existing beliefs. For example, after making an investment in a particular stock, an investor may actively search for news and analysis that supports the decision to make that investment, as opposed to considering other news or alternative analysis. Confirmation bias is clearly something that we're all subject to at different times. We get locked in on a thought and we think this is the only way to do it. And anything that comes along that says something different, we ignore it. We miss that because we're busy trying to feel confident that the decision that we made makes sense, rather than trying to create a more neutral thought process. You've heard me say before that we get information and news and data from about 14, I guess, different resources right now. And in those resources, some of them think like I think. They have my same sort of bent in the way they approach many things. But about half of them don't have my thinking. They think different than I do. And I have found over time that having an understanding of what each side is thinking helps to make better decisions. And so one of our goals this year and going forward into future years is to help to communicate that with our investment clients so they can make even better decisions, decisions that will match what their short, mid, and long-term thinking is. The second bias, overconfidence bias. That is to overestimate our skills or the circumstances, which interferes with our ability to make good decisions. For example, when evaluating a particular investment, an investor may feel really confident that they have a much better read or analysis than the general market does. I cannot tell you how many times each year I will have clients come in and say, oh, this is where we should invest. This is the thing right now. This is what's happening. And I will say, well, where did you get that from? And usually it's single source, but maybe it's a couple of sources where they've said, well, this person or this group or this individual or team says, hey, this is where we should invest because this is what's going to be big. And when they get locked in on that, from an advisory viewpoint, I'm going to tell you that's a challenging conversation because I may think that, yes, this is on the right track, but what if it's going to be 5 or more years before we get to see the benefits that they're hoping will happen? And what if they come along and those benefits do come, but they come from in a different model, not connected to how the clients invested? And so my job as an advisor then is to say, well, let's take a look at how to break this down and make an informed decision, a wise decision, because if we're going to put some resources into those different asset groups or those different funds or stocks, and they don't perform well over the next 2 or 3 years, waiting for this opportunity to finally kick in, then that then impacts performance on the portfolio, and the clients looking at me saying, why did we do that? And it's funny how later on, a year or two from now, they forget that it was what they wanted to do. And so we try really hard to make sure that everybody thinks through the process and understands if they're going to make an investment, they're not overconfident about it, but they're thinking clearly, wisely about what to do next. The other one that we struggle a lot with is loss aversion. Loss aversion is a tendency to be driven more strongly to avoid losses than to achieve gains. For example, even when presented with better investment opportunities, an investor may decide to keep holding a stock or an investment that has declined in value until it can be sold at a gain. We've all been there. We've had an investment that we purchased, that it went down, and we are trying to decide when it's time to get out of it. But we don't want to get out of it till it gets back up to at least what we bought it for. And so we hold on, and we're afraid to actually say, you know what, this was not the best choice. I can tell you that as an advisor, we buy things sometimes and I'm like, oh, I thought that was going to work a little bit better than it did. It's one of the reasons we diversify. We don't put all of our eggs in one basket because we're trying to make sure that if something's not working as well, other items are. But I can't tell you how many times I've had clients who want to hang on to a particular security because they just want to wait for it to come back. And while it's true, it will come back probably. There's also the fact that it might not come back, or it might be many years before it comes back. And if it is many years, then the question becomes, how much could we have made by using other investments rather than that item? And so consequently, we try really hard to get clients to think that process through to avoid loss aversion. Item number 4, recency bias. And that is a belief that recent events are more likely to occur than they actually are. For example, a year after a major stock market downturn, many investors still avoid investing because they believe that another major downturn is likely to happen in the short term. And so it keeps them out of the markets. It keeps them from different investment opportunities. And again, that recency bias plays heavily in their thinking. And so when I'm meeting with clients who have recency bias and I'm suggesting it's time to go ahead and become a little more aggressive, invest a little more wide span in our thinking about the economy and the markets, not just stay in safe investments, I have to constantly be careful because if they're of a mind that this is not a good choice and I say let's do it, things don't work out like we'd hope, they then feel even more disappointed that we didn't wait. On the other hand, if they decide to hold and I don't push on that and the markets do go up, Then later on, there's this question about, well, shouldn't we have done something? Well, yes, but as somebody who's trying to act in your best interest and think like you would think if you were managing this portfolio, we try to help clients think through that so that we can stay together. Because my job is not to tell you what you have to do. Any well thought out advisor is trying to help clients think through where they are, where they want to go, and then what are the best choices to get there. And recency bias is one of those items that can cause problems. And it's not listed on this one, but I can tell you recency bias when you have good markets is another problem, because if you have good markets and you say maybe it's time to pull back to get more conservative, again, the expectation is, well, it's been good so far, let's just stay where we are and see what happens. Well, by then it's a little harder to get done. The next is endowment effect. Endowment effect is the tendency to place more value on an investment that you own compared to the price it can be purchased for or sold at in the open market. For example, particularly for an inherited stock or a stock in the family business, an investor may value their shares more than the current market price would support. And that endowment effect, again, makes people, I can think of a client who had a particular mutual fund that when they brought their assets to our firm, there was one fund we could not sell. We had to keep that fund. And so for probably 3 or 4 years, I had to compare what we were doing to what that fund had done. And finally, after about 3 or 4 years, the client said, okay, we can start to liquidate parts of that fund. We didn't get the price that the client wanted or that I would have wanted, but the client had to come to terms with the fact that even though they loved it, it wasn't getting the same love elsewhere. And so having that as an offset is another important piece of investment management, not just managing investments, but managing investors' expectations, which now brings me to number 6, optimism/pessimism bias. And that's the belief that our chances of experiencing positive or negative events are lower or higher than the averages. For example, many investors believe that if they just have good returns over the short term, they'll be more satisfied and better off in the future. Well, that certainly is not unrealistic thought. I mean, I get why people would think that. But as I just showed you with the over and under estimate of market prognosticators, not just one, but a consensus of them, they missed what was going on. And if an investor just stayed with that model and didn't make any changes, they missed opportunities. And if an investor with the advisor's help is saying, no, we're going to hold, and the advisor's like, well, maybe we could make some adjustments, but the client's saying, not yet, we're still going to be stuck in that process. And so having either an optimistic or a pessimistic view is probably not the best approach, but rather to find somewhere in the middle of those two. Which brings me to the last bias that I seem to have a lot of conversations with people about, and that is political biases. We often make mistakes because we are unaware that our decisions are being influenced by our beliefs and biases. The first step to eliminating or at least minimizing such mistakes is to become aware of how our choices are affected by our views and how those views can influence outcomes. A 2012 study called Political Climate, Optimism, and Investment Decisions identified that people's optimism toward both the financial markets and the economy is dynamically influenced by their political affiliation and the existing political climate. Now, I can tell you that in other election years, and I may do it later this year as well, that it surprises people that when I tell them that market performance has actually been better under Democrats than Republicans, some people say, how could that be? Well, again, it has to do with biases. You might say, well, wait a second, how would a bias impact that? Well, because if the media is telling you everything is good, even when it's not, and people believe it and they start investing accordingly, then that money goes into the market. Now you might say, well, how does that fix anything or change anything? Well, because if you throw $1 billion into the S&P 500, it's going to do nothing but go up for a while. But sooner or later, if the data doesn't back up that thinking, the S&P will go down. And that's not just the S&P, it's the NASDAQ, it's the Dow, it's any individual security. When you throw a lot of money, you increase the volume, and it you throw a lot at it quickly, it increases the velocity of the money. It's going to then create this problem. So people who are thinking, oh, things are terrible, are not going to invest as much, and people are thinking things that are wonderful are going to invest more. So maybe what you would find is that if the media is telling everybody that it's really good or it's really bad, and the majority of people follow along with that, what they hear, then you're going to see a market reaction. And I think what you would probably think isn't too unrealistic is the media tends to favor Democrats over Republicans. I'm not telling you anything you don't know already, probably. And so they tend to see good news when the Democrats are in office. They tend to see bad news when the Republicans are in office. That's one of the reasons why, as I've shared that other election years, people are like, really? That surprises me. You would think that the Republicans are supposed to be pro-business. And if they're pro-business, that would mean the markets and the economy would do better. Well, yes, unless there is an overwhelming bias that says, no, it's not good. Stay away. Don't do it right now. Now, obviously, that's been impacted under the Trump administration, especially in 2020. The markets did very well. And because there was a lot of belief that some of the things business-wise was being done were good for the economy. Those are opportunities that do happen along the way, but we have to keep our eyes open. But most importantly, and I sidetracked for a moment, sorry about that. Most important, try to not let your political biases take over everything, and try to recognize there are opportunities. So how do we offset these biases that pop up and kind of drive what we're doing? So what we're going to call it is conquering your cognitive biases. How could you do such a thing? How could either of us do such a thing? I mean, if we believe something and we are intelligent people and we made an informed decision to choose wisely, then obviously our biases are going to be a result of that information. So how could we offset that, especially when it comes to investing money? So I'll start up here at the top. Cognitive biases are easy to understand but hard to prevent from negatively impacting our investment returns. Based on years of working with clients, we find that the following actions help investors achieve better investment satisfaction. That doesn't mean that everything works out perfectly or that it always works out right, but it is more satisfying when we do it this way. The first thing is this: identify your core investment competencies while utilizing others to help create, grow, protect, and preserve your family wealth. All of our clients, all of you on this review, you're intelligent people. You have areas of expertise, things that you're really good at, things that you know as good or better than most. But then you have many other things that you don't. And I'm the same way. I have some things I'm really good at and other things I'm not good at. And so what I do is I work in my strengths and I involve others to help me in my weaknesses. Or I might say it that I would classify myself as an expert in a few areas, and then there's other areas I might think of myself as sort of a 2/3 expert. I know a lot and I can make some good decisions, but I'm not the end all be all. And then some things I would say I'm probably a 1/3 expert in. I know enough to ask good questions. And then there's a lot of things I don't know anything about, and I seek counsel from people who do know this information. So what I would say is this: think about what your strengths are, and then use those to help grow family wealth, and then involve others to help make the difference. There are many different, I'm right here, there are many different investment styles that over time have helped people become wealthy. However, many investors focus on a few investment styles that they understand and ignore other potential investment opportunities. This micro focus can help investors in some ways while hurting them in others. Identifying your core investment competencies while employing others to utilize theirs can empower your family's ability to create, grow, protect, and preserve wealth for this generation and future generations. Number 2, develop strategies and systems that consistently and persistently do the work for you. Instead of making a new decision each time you have money to invest, which is stressful and time consuming, instead utilize a strategy / a process that automatically implements your predetermined investment policy for you, your investment policy, how we want to divide assets up. And I'm going to talk more about that in next month's advisory review. But that policy is what helps you set a plan that you can then work with, so you don't have to rethink everything every time, no matter what the news is telling you, no matter what you're seeing in the economy, no matter who's in office, but rather a process that consistently and persistently will implement the strategies that make the most sense for you and your family. And that's why I'm going to spend more time on that investment policy in our next advisory review. But for now, if you'll just hang with me, along with having that investment policy, regularly review your investment performance on a predetermined basis, quarterly, semi-annually, or annually, depends on you and how your situation works, but we've got clients who do each of those. And then review your investment policy biannually. So you don't set a policy in place and say, oh my goodness, this is the way we'll do it for the rest of our lives. You put an investment policy in place, and then you work off of that, and then every few years, you re-examine it to make sure it makes sense, that it's still meeting your thinking, your needs, and most importantly, your situation as it changes. So first off, identify your strengths and use others to help you offset the things you're not as strong at, and then have a strategy or a process in place, an investment policy that you can review how it's working in light of your stage in life and where you are and where you need to go next. I shared part of this last time. I'm going to update a little bit with you. Diversification is always working. Sometimes you like the results and sometimes you don't. Everyone is familiar with the benefits of diversification. It's certainly been talked about for 2 decades, longer in some environments, but I think most everybody's heard this term. Done properly, it reduces risk without reducing expected returns. But once you diversify beyond a popular index like the S&P 500, you must accept the fact that you will almost certainly be faced with periods, maybe even longer ones, when a popular benchmark index reported by the media daily outperforms even the most diversified portfolio. I would also say that in experience, we've been doing diversified portfolios for decades, but I can tell you there have been a couple of times when it didn't matter what asset group you were in, it wasn't doing well. The 2008, 2009, 2007, those times up 2008, it didn't matter what asset group you were in, it was struggling. And we had the same thing in 2020 when it didn't matter what asset group you were in, it was having a hard time offsetting anything. So it didn't matter if you were diversified 8 different ways, none of them were doing as well. But having said that, most of the time, usually a quarter of them, a third of them, half of those different asset groups are doing well, and they're helping to offset any downturn that the other assets are having. And again, I'm going to explain a little bit more about that as we take a look at how diversification is used here at Frank Reynolds and Company. To that point, I shared this stat with you last time. A 2019 Dalbar study found that the average equity mutual fund investor underperformed the S&P 500, a benchmark stock market, by nearly 5% annually over the last 30 years. So why would they underperform? Because their biases kick in and say, get out of the market. It's terrifying. I can't do anything. Or the market hits the bottom and starts to come back up, and recency bias are like, no, we're not doing anything right now. We're going to wait because I think it's going to get worse again. The fact is, the media is constantly talking at us. Every night they have something to say. You may even have some people you listen to. I'm not going to say any names, but they're always telling you what you should do. And because they're on TV, you think, well, they must know what they're talking about. But they don't. Sometimes they get it right. Many times they don't. They're in that group of those people who overestimated and underestimated the S&P 500. But what you have to really begin saying is, if I have a strategy that I'm going to stick to all the time, then it will work in a much better fashion than getting in and out. Because in that study, the 2019 Dalbar study, it found that the investors missed the opportunities to be in the market, or they got in late and stayed too long, and when it went down, they had lost whatever gains they would have had. So it's a management process, and it's a commitment process. Conquering your cognitive biases. Next, I would tell you is to mitigate your downside risk. Try to reduce your downside risk. And we talk about that a lot in client meetings. What are some of the best ways to offset downside risk? And I'm going to talk a moment about what that really means. It's a term called drawdown. But for right now, Warren Buffett, everybody knows who Warren Buffett is, or most people do. He has 2 rules about investing. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. It's cute, makes sense, sounds good. But it's important to understand, even Warren Buffett loses money, just like every investor does. However, he's very careful to minimize losses. and you and I should be too. When deviating from your well-designed and implemented investment strategy, more things can go wrong than go right. So make sure that if you're going to deviate from your strategy you have in place, that you have done so in such a way that you have such advantage, it makes a lot of sense to take that risk. So here are some things that I encourage our clients to do. One, recognize your risk tolerance and how it impacts your investment performance. And what I mean by that is this: a 50-50 stock bond mix will not perform like the S&P 500, which would be a 100% stock investment model. If you have 50-50, 50% in stocks and 50% in bonds, you can't expect it to match the S&P 500. Now, sometimes it won't perform as well, but other times it'll perform better. Because if the stock market or the S&P has gone down 10%, but the bond market's gone up, the 50% of your portfolio that is mixed in more conservative investments will help to offset that and give you some growth and not fall as far or as fast as the S&P 500 did. But understand that your risk tolerance has a great deal to do with your ultimate outcome from your portfolio management. Number two, know your risk tolerance, invest your risk tolerance, and reevaluate your risk tolerance annually as you learn, change, and grow in your understanding of wealth management. I can't tell you over the years how many times I've had clients come in who thought they were aggressive investors because they had heard a few things, read a few things, seen a few things, and thought they were. And the first serious market downturn, they realized they weren't. Conversely, I've had people who've come in and said, I'm very conservative, I don't want to take any risk whatsoever. And so we start that way, but as they begin to see how some of their investments that are a little more aggressive than what the rest of their investments are, they see that, they begin to understand they can handle more risk than they realize. And so having that awareness as you reevaluate your investment strategies and your risk tolerance, as you learn, change, and grow to become a mature investor, can be critical to helping you increase the value of your family wealth. Number three, identify your cash reserve needs for emergencies and opportunities at least annually. So your cash reserve has to be there for emergencies that might pop up or opportunities. And so at least annually, make sure that you have enough cash reserve to make it so you can handle those emergencies or opportunities. But likewise, don't have so much because cash reserve money doesn't do as well. It's more conservative because it's daily liquidity and you got to be able to get to it, so it doesn't earn as much. So don't have too much there, because if you have too much there, it's going to slow down your portfolio as well. So if you identify what your cash reserve needs are, you'll make better decisions along the way. Annually, identify your investment portfolio income needs for the coming 3 to 5 years. Some of you, and you might say, well, 3 to 5 years, how would I know what that is? Well, some of you aren't needing any income from your investment portfolio at this time. You don't need it. It's not on the table. You can just stay invested like you are. But some of you are pulling out money from your investments. You might be pulling out $2,000 a month or $5,000 a month or $10,000 a month or $20,000 a month. And so if you're doing that, let's say you're pulling out $5,000 a month, that's $60,000 a year. That's $60,000 a year times 5 years. You're looking at $300,000 that you need to know that you can get to, that will be coming out to you every month, no matter what the market does, no matter what the economy does. You want to make sure you have that money available, and not only the $5,000 a month, but the $5,000 a month plus inflation to offset the rising cost of living. If we, as your advisors, know what you're looking at income needs over the next 3 to 5 years, we can help you make sure that's set aside, available, ready for you. And then whenever we have really good years in the market, we can then take that and replenish that bucket to make sure your income will continue on for many years into the future. So knowing what your income needs are in the next 3 to 5 years can help your advisor really help invest more intelligently for your situation. Next, diversify your investment portfolio according to your risk tolerance, a varied mixture of asset classes. And that doesn't mean different stocks, although it can, but stocks, bonds, cash, real estate, currencies, commodities, private businesses in certain cases. Those can all help to grow your wealth and give you that balance in case some things are working better than other things. And wherever possible, utilize some sort of a risk mitigation strategy that can help protect your assets if the markets go down. Maybe it could be a third-party manager. Maybe it could be plans within your investment policy to minimize risk to no more than 10%, or whatever that is. It could be different strategies that can give you protections like barriers or buffers. Any of these things could be great solutions, but implementing that wherever it makes sense and meets your needs is critical. This will help you to grow and protect your family's wealth and help your advisor to help you make the best decisions possible and get you through those times when the market or the economy isn't quite as friendly. Next, regularly review your investment performance and your investment policy. I mentioned a moment ago, reviewing your investments, not daily. You'll have to do what you want, but don't look daily. Don't even look weekly. Monthly is probably too soon, but certainly quarterly or semi-annually or annually helps you get a good flavor for what's going on. And if you've got a great investment policy in place, you don't have to worry about that sort of thing. And you review your investment policies, I said a moment ago, about every 2 years, just to make sure that everything is making sense in your world and in the world at large, and that everything is balancing well for your strategies and your family's investment needs. Last, trust the process. A diversified portfolio is not a perfect portfolio, but utilized within a financial plan, an engaged investor will likely reap the benefits required to meet your family's financial goals, both today and in the future, and maybe into future generations. Because if you have a good plan in place and the plan is making sense and it's functioning like it's supposed to in good and bad economies, then that way you're going to be able to hold firm even when things around you, including the media, are telling you otherwise. So when I talked about the income a moment ago, 3 to 5 years, part of how we help people who are retiring is to begin looking at what their income needs are, so they don't have to make distributions from their portfolio when the market's down. If you're pulling out, say, and I'm going to use a number that's probably big for some, but not for others. Let's say you pulled out $10,000 a month. That's a huge number. Okay, but you pull out $10,000 a month. If the market goes down 20%, that means you have to pull out $12,000 to get that done. And when I say that, you don't pull out $12,000, but what it means, you have to sell off more of the securities in your growth-oriented equity, more aggressive, risk-oriented, return-seeking, inflation counterbalancing portfolio if you have to pull out when the market's down. That's why we say if you have an income-oriented bucket over here that gives you confidence that you're going to get your monthly income every month to meet your needs, you'll always be fine. And then whenever this portfolio does really well, you simply replenish the years you've taken out. So if you pulled out 25,000 or 100,000 or whatever your number is from your income bucket, and the markets have done really well, we can take from here while we're not pulling from being down, we're pulling from it while the market's up, which means we're actually getting benefit and growth out of that to help you contain or confirm or continue your income needs. This is what we call your income to growth ratio. And so what we do with our clients that are retired and have this income need in place is we have their tactical income, or what we call the TACT-INC, income distribution management model set up for them. We have their strategic growth or strat grow portfolio set up to manage the investments according to their risk tolerance. And we replenish these whenever we have good years over here. And when we don't have good years, we just set and leave the money over here because we know it will come back. And I'm going to talk about that in a second as well. So by doing that, it gives you confidence as you go forward, and you don't have to get concerned or lose sleep or anything as you watch the markets go up and down as they do. Yeah, we had a great report this month about what the S&P 500 has been doing for the last few months. It might not be so good another few months from now, but clients shouldn't be losing sleep over that because we've got a plan in place for them with their income to growth ratio and their investment policy statement, and looking at how their performance is working in comparison to that. You've seen this chart so many times where I show you that we look at these 8 different circles as investment opportunities. Cash reserve for your emergencies and opportunities. Bonds to help with protecting portfolios in down markets. Equities to help with growth in good markets. real estate to help with growth and income in good markets, tangible assets, things like commodities or energy or metals, things that are making money that aren't in these groups. Currency, using the US dollar when it's fluctuating against other currencies, sometimes betting with the US dollar, sometimes going against the US dollar. For clients with more capital and meet an accredited investor model strategy, we can do certain business interest programs which are not publicly traded like stocks, but privately held. And then insurance and annuities as a strategy to give income, give growth, and actually mitigate risk for clients when it comes to protecting assets or income or both in down markets. So these 8 items give our clients in your portfolio the ability, as it blends with your investment policy, to meet your short, mid, and long-term goals. We diversify with your needs in mind in your investment allocation blueprint, and that's what the plan here is. And so we take a look at these 8 different items, that I'm going to cover more next month, but making sure that these are set according to what your needs are, your cash reserve needs, your income to growth ratio, your probability or surety based upon the risk mitigation strategies, tax management, so you're not giving so much to the IRS, matching your risk tolerance to your strategic growth portfolio or strat grow, dollar cost averaging at times when it's appropriate because it makes more sense to split it up over a number of months rather than just put a lump sum in. Understanding asset cyclical management, weighting and weighting, how you weight these various circles and how long you wait on them to work through their cycles. And then maintaining entry and exit strategies for the more aggressive investments. This is part of our investment blueprint allocation, but it's also part of your investment policy strategy. And the more we understand about what you're needing, the better job we can do to help you accomplish that and diversify with your needs in mind. Now, I shared with you, or mentioned earlier, I was going to talk about drawdown, understanding the impacts of drawdown on your investments. And I'm going to actually go to the program we use to help clients understand this. Oh my goodness, I'm running over tonight. I guess I did have that 5-minute stop. All right, so what I'm looking at here is the S&P 500 from 2000 to 2022. They'll be updating this information later this month for 23. But what we see here is we see each year the annual return for the S&P 500. And what we see is we see that in 2000 it went down 9%, then it went down almost 12%, then it went down 22%, then it came back up 28%, almost 27, or 29 I mean. Then it came up almost 11, about 5, about 16%, and so on. And we can see this each year what it did. And so you say to yourself, well, what's that return? I mean, these great, show me the years, but what's the average return? Well, the average return for the S&P 500 from 2000 to 2022, the end of 22, was 7.94%. Now, that may be just what you thought it was going to be, or it may be not what you thought. Maybe you thought it was going to be, higher single digits, or maybe even double digits. But for this period of time, that's what it's been. Now, if you take out dividends, so for instance, if you're using an exchange traded fund that doesn't share dividends with you, that changes from 7.9 to 5.9%. So having the right kind of investments internally to get dividends can actually offset this because you get to buy some more of the shares at cheaper price when the market's down. On the other hand, we'll go ahead and leave those dividends in for now. Even if that's the case though, while the average rate of return was 7.94%, the actual rate of return was 6.26%. Now you might be really perplexed. How come the markets did 7.94%, but the actual rate of return was only 6.26? Is that because of greedy fund managers or advisors who were getting fees? No, that's not part of what this problem is. Is it because of taxes you had to pay? Nope, that's not what this calculation is either. What this is off of a concept, or not a concept, but an issue called drawdown. So let's just say that, for instance, we put $1 into our investment account, and on January 1st of 2000, and the market went down 9.1%. That meant that my $1 was now worth 91 cents. Next year, it went down 11.89%. Now my dollar is worth 80 cents. The next year it went down 22.1%. And now my dollar is worth 62 cents. Now I'd like to point out that this isn't common. This doesn't happen a lot. This is why this is called the Great Recession. It's one of those times where things were really bad. We also had a similar problem in 2008, but it's not typical. As a matter of fact, you're going to see more positive years than negative years. But having said that, my dollar is now worth 62 cents after 3 years. Most people are not happy about that. To the rescue, 2003, the market went up 28.69%. So, okay, now things are starting to work out again. That's really good. Except for the problem is I get 28.69% on my 62 cents, not my dollar. So even though I get 28.69%, it brings me up to 80 cents. I'm still below my dollar. It went up almost 11%. I'm at 89 cents. Still not my dollar yet. 4.91%. I'm still not at my dollar yet. It's not till 2006 that I actually get back to my dollar. I go to $1.08 at that point. So after 2000, we got it 1, 2, 3, 4, 5, 6. Yeah, 6 years for me to get from $1 back up to $1.08. At this point, a lot of people are saying, "But Frank, I could have done better if I'd just been in a bank CD or something." And that's not wrong. They would have been. But had they taken some other times in the market, for instance, there's other times where it would have done much better. So again, this is why, back to my point a moment ago, cash reserve, bonds, equities, real estate, commodities or hard assets, currency, those are items where you diversify because different things do well at different times. And lest you think that it's just the S&P 500, the Dow had its same problems as well. 5.81% per year from 2000 to 2022. 4.71 was its performance after drawdown. And while it didn't go down as bad, it did go down all 3 of those years as well. It also went down in 2008. Now, when I say risk mitigation, if there was a way, and this is part of what I mean by risk mitigation, if you have a way to put barriers or buffers into items that can protect you on the downside, that might have some value. For instance, if you could say, look, I'm just going to put a floor so I can't actually lose money, that would then be it could be like a barrier, or it could be a protection that could be offered by a note or an annuity that says, look, you won't make any money in these years where it goes down, but at least you won't lose money. So for instance, the market went down 6.18%, but because there was a barrier that protected it, you still had $1. You didn't make any money, but you still had $1. Went down 7%, didn't lose, still have $1. Now you say, well, wait a second, on the upside, that went up 25%. So that meant my dollar went up to $1.25. You can see that performance went from 5.81 to 9.33 if I could stop or mitigate those risks. Another important piece, still had some drawdown because you didn't do performance every single year, but at 8.95%. Now, I can assure you that no company is going to say, look, we'll let you have all the upside, but you don't have to take any of the downside. No, they're going to charge something. They're going to get a piece of that. They might charge a fee for it, or they might charge an annual expense for it, but it could be worth it if you're skittish about the markets and you want your risk tolerance and your investment performance to net out a good model for you. So when you look at how to avoid this drawdown, there are different ways that you can help to protect some of that. Diversification is obviously the first and most important one, but there are other things that we can talk about as well. Let me go back to our chart here. For those of you who are getting ready for dinner, I know I'm running a few minutes over, but I'm almost done. What I want you to do, though, is to realize that we can match a client's investment tolerance if we understand what their investment tolerance or risk tolerance is. We can look at putting protections into their accounts to give them opportunities to protect it if the markets go down. We can diversify to help protect that. And we can build a policy strategy, investment policy, to make sure that you always understand what you're doing. And for those of you who have that in place, you already know how to compare this. For those of you who don't, my encouragement is let's get together and start working on getting that done. Continuing to conquer the cognitive bias, respect the averages and respect your plan. Only deviate from your plan if you actually have a real advantage. And again, overconfidence or endowment effect could cause people to think that, but many studies have found that investors who buy and hold broadly diversified, low-cost domestic and international index, mutual funds, and ETFs outperform many investors over a long time. As a result, you don't have to have a particular competitive advantage. You just have to have a plan that consistently and persistently matches what your goals are. Another important piece is I think sometimes people imagine that if they can just get that get rich quick scheme or that great investment or that next Tesla or whatever, that they're going to somehow be more satisfied. And that's not true. More money probably won't make you feel more satisfied. Through research, Nobel Prize winning psychologist Daniel Kahneman has found that while being poor makes people miserable, that makes perfect sense. For most people with a functional level of wealth, more wealth does not significantly increase day-to-day well-being. Once an investor has a good investment strategy in place, reviews their strategy periodically, they spend more time and spend less time on analyzing investments, it's unlikely to significantly improve their returns. If they have a good plan in place, they're going to be fine. And as a final thought for that, as many studies have shown, for most people, investing well over the long term is tough. It's tough. I've been doing it for 3.5 decades. I can assure you, it's a lot of work and a lot of discussion. I happen to love it, so I enjoyed it greatly. But it's a tough job sometimes. By understanding ourselves better and creating well thought out and systematic investment solutions, investors are more likely to achieve the satisfaction they desire in their family's wealth management. As a reminder, to kind of tie all this together, there are 3 phases to your financial journey, and all of your biases and all of your plans and all of your goals and desires are found in these time frames. You start in your 20s and you say, look, I want to start working and build a career. You get to your 30s, 40s, 50s. Your career is probably at its apex. Move into the 60s. Somewhere in there, you're starting to think it's time to plant my flag and retire or redirect. You plant that flag, you retire somewhere in the 50s or 60s or 70s. You begin going down the slope. You want to make sure your decumulation works well, just like your accumulation did. And then one day, you're no longer on the planet, and those assets that you've been working so hard for transfer to the people that you love and care about. Hopefully, not the IRS. And with some good planning, that certainly could be the case as well. While all of this is happening, making sure that you're getting your desired return on life. Yes, your return on investment is important, but your return on life is what we're all thinking about at the end. We do this by helping clients identify their personal return on life goals, creating and growing wealth through their investment strategies, protecting and preserving wealth through tax, trust, insurance management solutions that are all designed to reduce risk or at least manage it well, so that we can protect and preserve wealth and get their income needs and their growth needs at the same time. We do this through a wealth advisory plan, a financial plan, if you will, that's helping you to determine where you are and where you're going. And from our viewpoint, a fiduciary wealth advisory thought process requires a dynamic financial planning strategy. And that's why we encourage our clients to have a financial plan, not only to make sure their investments are working for them and their risk mitigation is working for them, but to make sure they're really on the track to realize the retirement or redirection they want to have. Part of ROL is understanding that we all have 168 hours a week, and we all can divide those hours up however we want to. You have your current life portfolio of 168 hours and time management. We'd like to help you rethink that as you get closer and closer to planting that flag, or even if you are retired right now, how do you do it? Or maybe you're not retired yet, but you want to enjoy life a little bit more. Looking at how to balance out your goals with 168 hours you have, that's your retirement mentality. And we try to help clients identify their ROL balance as well by looking at some of the things they might want to do and considering the possibilities to make their retirement mentality a reality. As I've shared before, I'm just going to quickly run over it. We have 4 applications that are available to all of our clients. If they're planning clients, they get all 4 of these. If they're just investment or insurance only, they get a few of these. But the point is they're all available to you. We have planning software designed to help you figure out if you're on track or not. If you have your investments with us, we have an investment portfolio dashboard that tells you performance and how things are working and gives you more details broken down. Your risk reward evaluation. I've touched on risk tolerance a great deal tonight. This is a favorite software that I want to really get more of our clients using so they can understand their investments with us and their investments outside of us, if they're matching that risk tolerance to what they really need and can meet their short, mid, and long-term needs. And then this is where we identify your life transitions and your bucket list, your financial life plan, which attaches your desires and feelings to the facts and figures of the previous three. Those financial dashboards and the tools I just showed you give you 24/7, 365 access, reports that match all your needs, an electronic vault to protect your assets in case, God forbid, something happened to your home and you couldn't get to your important box of information. Planning and wealth management reviews every 4 months, beneficiary estate design and income tax reviews, annual risk management assessments for your insurance programs, either those with us or those outside of us, your return on life review and update of your transitional life goals, and then, as we're doing tonight, your monthly advisory review webinars, updating you on wealth management strategies and economic and market issues. So here's my final thoughts for today, and I know I'm really running over here. Well, I guess it's 8 minutes, but still, I'm sorry I'm done that. If you just joined us late, we had actually like a 5 or 6 minute stop where PowerPoint decided to do something. I guess Bill Gates and Microsoft didn't want us to talk about some stuff tonight. Anyway, continuing, we're going to continue, as you should, to monitor economic and market conditions for opportunities and threats. Recognizing your cognitive biases can help investors learn, grow, and change. Conquering those cognitive biases can help you become a more successful investor. Identifying your investment policy is crucial for making your investment portfolio more effective in meeting your family's financial needs. Understanding your investment portfolio management goals is essential to making intelligent investment decisions. Identifying your investment expectations and communicating them with your wealth management team is critical for that kind of financial satisfaction. And fiduciary wealth advisory requires that dynamic strategy to make sure that the investments, the insurance, the risk mitigation, the planning are all working well together for your needs in a complex economic environment. So I'm going to go ahead and finish this out. I'm getting ready to close up a few things, but if you have questions, please go ahead and let us know. I'm going to pull those up in just a second. Again, you can either raise your hand or you can chat your question. I'll be happy to answer that. Our next update is going to be March 12th at 5:30 p.m. We're going to talk more about investment policies and how the modeling of the different strategies we do blend together to create that portfolio for you, and talk about a few other items that I want to add into the mix so that as we come through this, the first part of this year, the first quarter of this year, that we really have got you set on a good path to go forward. So we're taking a look at market fundamentals and technical analytics and other strategies as well. I hope you are checking out our weekly updates. You can go to Facebook, Twitter, LinkedIn. You can go to our website where we upload these advisory reviews so you can look at them later on if there's something you want to see again. So please, we put a lot of energy into trying to make sure that you have all the information you need, weekly updates, these monthly advisory reviews, the applications that we provide, and then certainly all of our time with clients, helping them to assess where they are, where they're going, and if that matches where they want to be. So as I told you, we did our market and economic review. Wanted to hopefully get you to start even maybe think a little bit more about how chasing performance can make you miss opportunities, how the cognitive biases are affecting your investments, how ways or strategies to counter that cognitive bias. Remind you again of our wealth management process and how it works. I took some time to share the final thoughts with you, and I'm going to just double check here and see if there's any questions. Sometimes PowerPoint doesn't let me see if you're doing something. Let me just see here. If there's any questions. No chat, no question, raise hand. Wow. Okay, so either A, you have you've understood everything so well that you don't have any questions, or B, I've confused you so much you don't even know where to start. If it's the latter, please call the office, schedule time to come in, and I'd be more than happy to discuss with you any particular item that you want to know. Our team here is here for you. We, as always, want to help you achieve your goals, accomplish what you want for your family, and make the most of your wealth management process. If you have questions or you want to invite friends or family to these webinars, they are always welcome to come. We just need to let us know. You can let Kayla at franksoffice.com know, or you can call the number 248-2121, and we'll be happy to send an invitation to them. I know this goes without saying, or at least I hope it does, but your friends are welcome to attend, and we're not going to chase them down and say, you got to do business with us now. If they're interested, we'd love to talk with them more, but if they're not, join in, listen to this, learn, and hopefully that'll help them with what they're doing as well. I was just talking with a client today about his son up north, and he had some questions. I gave him the answers and said, if your son wants to talk to me, just by all means, let him know. We'll be happy to talk to him. But if not, much success, super success for what he's doing, and want the best for everybody. All right, that's all I've got tonight. I'm going to check one more time on questions, and if there are no questions, I am going to let you go. I again apologize that we ran late tonight. I was going to figure out what happened there with PowerPoint, but until then, I'm just going to bid you adieu. I'm going to go have some dinner, and then I will look forward to talking to you all soon. Have a fantastic night and a blessed week, and I will look forward to talking to you all soon. Good night.